If you're putting together the menu for Thanksgiving dinner, here's a little tip. Nobody likes the creamed onions. Investor Beat starts now. Thanks for watching. I'm Chris Hill. Maybe it's just me who doesn't like the creamed onions. Green lights on Wall Street, with Home Depot and Disney helping to push the Dow higher. Home prices in 20 U.S. cities came in strong, increasing the most since 2006. Joining me in studio today, David Hanson and Matt Koppenheffer. Guys, our top story today. Last month, Joseph A. Bank offered to buy rival Men's Wearhouse for $2.3 billion. Men's Wearhouse immediately rejected the offer, but today turned the tables and made an offer to buy out Joseph A. Bank for $1.5 billion. And I'm assuming Wall Street likes this because both stocks are up today.
Yeah, it appears so. And when you go back to the original offer that Joseph A. Bank offered Men's Wearhouse, it was a little interesting. Men's Wearhouse shot it down almost immediately, but Joseph A. Bank stood there and said, well, if you want to buy us, we're interested. So it was definitely an interesting offer at the time. It seems to make sense. The market likes both. Joseph A. Bank is actually trading above the offer price, so maybe investors are expecting more.
We've talked before about apparel retail, particularly teen apparel retail can be really tough. But to David's point, this really does seem like it would make sense to have one entity here.
It seems like it would, and as compared to teen retail, this is obviously a lot more predictable, this business. However, if I'm a Men's Wearhouse investor right now, I don't know how crazy I am about this. I think maybe over the past 5 years or so, maybe 10 years, Men's Wearhouse has just, I think, built a stronger brand than Joseph A. Bank. And what Joseph A. Bank is known for right now is deals, is sales. And that's not great for the brand, I don't think.
Well, and it also goes for the stock too, right? I mean, you look at Men's Wearhouse over the last 1, 2, 5 years, it's pretty substantially outperformed the market. If they're the ones who are operating, they're the ones who are the head of this new entity, is that a reason to jump in here?
I wouldn't be jumping in here. I'd probably wait for the dust to settle. I mentioned the stock was at Joseph A. Bank was trading higher than the offer, so I think we could see some activists, maybe some merger arb hedge funds come in here and try to create some noise. So I would wait for the dust to settle a little bit. It may look interesting after, but right now I'd stay away.
All right, let's get to some of the day's movers and shakers. Cracker Barrel's first quarter profit rose 17%, but shares down after the restaurant lowered guidance. Still, they're having a hell of a year.
This is a really nice quarter. They're trying to deal with the interest, we'll say, of Sardar Biglari. He's got a big position.
Speaking of activist investors.
Yeah, exactly. 17% of Cracker Barrel stock, and he wants a bunch of things, including potentially a big dividend. But in the meantime, Cracker Barrel seems to be starting to fire on all cylinders here. The guidance wasn't what people had wanted, but I think this is a classic short-term view by Wall Street.
Tiffany up after third quarter profit rose 50%. Same-store sales were up 7%, and they raised guidance. Did anything bad happen this quarter? This looks glowing.
Yeah, it did look pretty good. Very strong sales in Asia, too, and that's probably one of the concerns that when Tiffany takes a hit, is that Asian consumer maybe not as interested in the high-end products, but didn't seem to be the case there. The stock is a little pricey, in my opinion, but if you believe in the Asian consumer, in the European consumer coming back a little bit, I think this can be a good growth story, but looks a little pricey today.
Twitter up a couple of ticks today. The company's new head of retail advertising is hoping to lure more advertisers this holiday season. You look at the stock, still way above that IPO price of $26.
Sure, but when you look at Twitter's total valuation versus, say, Facebook, it's still a small fry in comparison. And maybe I'm going out on a limb here, but I think Twitter may have a better potential to monetize its service versus Facebook. Call me crazy.
And finally, Barnes & Noble down after second quarter revenue fell 8%. The digital book division down 30%. What happened to the Nook, David? What happened to the Nook?
The Nook, nothing good at Barnes & Noble. And this is a stock that's basically priced, obviously, for imperfection almost. So I think someone could come in here and potentially buy out Barnes & Noble. Maybe you'd make money that way. But the business itself, just not great. And in their press release, this is what they said. They said, booksellers are prepared to welcome holiday shoppers and recommend thoughtful gift ideas. I mean, that's their strategy, is to offer good book ideas. I just don't see this working out very well.
All right, that's going to do it for today's action. Let's look ahead to the rest of the week. short week because of Thanksgiving, but give me a stock I can put on my watch list.
I won't say that eBay wasn't already on my radar from PayPal, but just the other day I got an email saying that I get a $15 off my next Uber ride if I connect it up to my PayPal account. Yeah, you should do it too. I really like the PayPal service. I like the opportunity that's there, and this just seems like a good time, good opportunity to take a deeper look and see if this is worth buying.
All right, David, what about you?
Going with a company called Cerner. This is a IT provider for hospitals, specifically electronic medical records. So a little bit out of my comfort zone, but it's a stock on my radar. I'm interested in it. One of our analysts on the Rule Breaker service is very interested in the company. It's the market leader, so Cerner's on my radar.
All right, for David Hanson and Matt Koppenheffer, I'm Chris Hill. Thanks for watching. We'll see you tomorrow.